With the recent sell-off in Bitcoin and the main markets, a lot of people are worried, how low could this go? And we understand, as crypto technical analysts, two very, very important rules. Rule 225, Bitcoin cannot escape the stock market's gravity. Bitcoin's fate is tied to the main markets. We also know Rule 45, no alt can escape Bitcoin's gravity. Your beloved alts are tied to Bitcoin's gravity. Hence, looking at the main markets is incredibly important to do. And it's also part of our process of marking up the charts with the CTKS method and then looking beyond the charts into the stock markets, checking world events and collecting probabilities before we come back into the crypto market to find the market's focus. When we do our charting, we always subscribe to positive excellence. Positive excellence is all about doing the right thing. It's all about integrity, decency, kindness, and authenticity. And this really matters when it comes to advising people, and even more important when we actually create charts. When we create any kind of chart, we have no story. Rule 238, this is a very, very important thing to do. And when we look at the markets, they've come down quite a bit. We still don't have a story about those. It's natural to ask then, so how do we figure out where the market is going? We can look back into past history, and if we use peak-to-peak charting, we actually can take any drawdown that has occurred and overlay that onto the current price, and this provides us, if you like, a form of guide rails to understand where the market can go based on where the market has actually gone before. What you see in front of you is a fractal, and a fractal is a piece of price action from the past. Inside the masterclass at lesson TG35, we always do our own fractals. That's because a lot of mainstream media commentators stretch and distort theirs. As crypto technical analysts, we just don't do that. That would violate integrity. I'll just quickly explain what peak-to-peak charting is all about. You can see that the particular price action between the 18th of February 2020 and the 18th of February 2022, generally we take these fractals out between 2 to 5 years. It of course always depends on where the price data is when the markets go down. We just didn't have that much price data in front of us here, but you can see from the bottom peak we came down about 35.41% and we came up to the top peak of around 120%. With price action from the 17th of September 2018 to the 17th of September 2021, we get this fractal again. And what did we see? We had a kind of a double dip here. We went down and then we went up, and we came down 20%, and over 98 days came up nearly 45%. And then we went down that 35.41 in 34 days. And then we went up. We can see that we moved up in about 525 days, up 107.4%. Why isn't it 120%? Because we got up to here. We always use the same date to the same date, putting it a fixed number of years apart. We don't cherry pick. And if I was to move the fractal back here, you can see that that fractal finishes there. Let's go to the sell-off that reached a peak 8th of October 2007, and it went through 5 years to the 8th of October 2012. Why do we use 5 years? Because it gives you a really good understanding, if you're a trader or an investor, of how things actually move around. This is really important to do, and we can see from the peak of this particular price action down to the lower peak, we sold off 57.39% over 504 days, and then we came up nearly 120% in 1,302 days. What happened with the dot-com crash from 2000 to 2005? We came down a total of 49.77% over 770 days, and then we rallied up 62.09% around 1,029 days later. When we look at the peak from the 24th of August 1987 to 5 years out, we can see that we came down around nearly 36%, and then we rallied up to the top 96.4% over 1750 days. From the 15th of September 1980 going forward 5 years, we can see that we actually came down from peak to peak down 28%, and then we rallied up 100% over 1204 days, and we came down over 623 days. What the beauty of this is that we can start to see what price action may actually do, and these are the 9 key sell-offs in the S&P 500 since 1966, mapped to the current price. When we look at the sell-off from the 8th of January 1973 going forward 5 years, we actually came down, or the S&P 500 came down 49.93% over 630 days, and then rallied up 78.35% over 721 days. When we look at the sell-off between the 2nd of December 1968 going forward 5 years, we see a 36% decline over 540 days and around a 78% increase over 958 days. You can see that particular retracement and then that rally. And then from the 7th of February 1966 going forward 5 years again, we can see that we came down 23.69% over 245 days, and we rallied up 51.31% over 784 days. What we're getting here is a bit of a blueprint on how prices have been moving. I'm going to track this each and every day on the main channel, but this is your helpful video to understand what it's all about. A lot of people actually fear corrections, but they're very, very important, and they're always required. And actually, the way to get rid of fear is by understanding how percentages work. If price comes down, for example, 56%, and it just regains its previous high, it comes up much more than 56.42%. It comes up 129.45%. That's why Rule 359 is so absolutely critical. Be on the right side of the percentage. You can be on the wrong side of the trade, but on the right side of the percentage, and you'll do really well. As a community, we're the smart money community. We stay away from retail thinking because retail emotions are always full of anxiety, denial, panic, anger, aggression, hope, optimism, thrill. It's absolutely exhausting. Smart money doesn't even go there. Because basically emotions are a trap in financial markets. That's why having a positive excellence focus and being unemotional, mastering emotional control is so absolutely critical. And that's what we talk about inside the masterclass. And I really like this little cartoon because it just speaks to the truth of the financial markets. When price is going up and up and up, and it looks like it's never coming down, people are getting absolutely thrilled. They're FOMOing in. Don't forget, this is the retail mindset. But the smart money mindset is getting really concerned when price hasn't pulled back to a reasonable level, because it means the price rise is unsustainable. And the more parabolic, the greater the price must decrease to normalize things. So when inevitably it hits and price starts to come down, retail mindset just scatters. Now, something really interesting happens here because the price starts to come up as all the retail investors and traders are exiting the floor through terror. They're basically climbing the walls. This cartoonist was really, really good. The concept is price is bid up to capture retail again, and we win or learn and never blame. And that's part of our CTKS creed. But the concept behind this, you want to be smart money. The best songs are playing when the dance floor is empty. And I think it's incredibly helpful to know that price can come down a lot, like 60%, but it can go up 100 and 20%. And of course, over time, it can go up a heck of a lot more than that. As smart money, we don't fear corrections, we just manage them. Rule 621 is buy on red, sell on green, but not all reds are created equal. We always have to contextualize the market. The first thing we do with Borsog A&F is that we understand we control the trade, but the market controls the return, and we spend a lot of time analyzing how the market's feeling, its general health. And of course, we need to know how we're feeling as well. We just do a traffic light. First of all, we do our three-dimensional thinking. What if this trade goes against us? What do we do? If it goes nowhere, if it goes flat, what do we do? And what are the percentages assigned to these things as well? And if it goes for us, what do we do? All of these questions have to be asked and answered before we enter any specific investment or trade. One thing that you'll find incredibly helpful, and you can just do this as an exercise for yourself, is just write out your Borsog synchronization code. That's that little thing down here. Just say to yourself, what do I feel the market is going to do within the next 24 hours? Is it going to go down, which would be a D? Is it going to go flat, which would be an F? Or is it going to go up, which would be a U? And is it going, the trade, the market, is it going to turn against me? What percentage do I give that? If it was against and 90%, that's what that would look like in the code. And if it's going neutral, what percentage is that? That's what that looks like. And if it's going to go for me, what percent? And what does that look like? Of course, this all adds up to 100%. And the most important thing to take a note of is how synchronized in with the market are you actually? If you're 100% synchronized in with the market, it doesn't matter what happens. Inside the market, you're going to do really, really well. And that's why we use small trades and Borsog. Just like day trading or other forms of trading, I invented Borsog trading as an investing and trading market synchronization technique. It has a very specific purpose. It's for you to use very small position sizes and then scale when you're in synchronization. So when you're in synchronization, you can scale your small trades up. But if you get out of synchronization, if you desynchronize, you need to descale, because when you're out of synchronization with the market will take your money. And sometimes it's perfectly valid just to sit on the sidelines and chill. You don't have to be in the market every single day. In the daily channel, I'm going to continuously track the current price of the S&P 500 against all these 9 sell-offs. These are the 9 major sell-offs since 1966. These are 9 major sell-offs in the market, and you can see the majority are 35% and below. We've got a couple at 50% and one at 60%. So that can kind of contextualize where this price could go as well. And when you've picked up your trading skills, knowing how to time the market, get in synchronization with the market, you can buy incredibly well as a hodler, as an investor, and you can get on the right side of the percentage and enjoy these kind of returns. They're good returns.